everybody. Welcome to the Wall Street Journal Report. I'm Maria Bartiromo. Fiscal cliff or fiscal molehill? Worse than we thought or nothing to worry about? Two strategists with two very different opinions. And why what happens in Washington might not matter that much. Then decisions. It's year-end tax time. Should you sell your winners, get rid of dividend companies, or just sit tight? We'll have important advice. And then he went from living on the street to living in lap of luxury. John Paul DeJoria's remarkable ride. You went from homeless to a billionaire. The Wall Street Journal Report begins right now.
This is America's #1 financial news program, The Wall Street Journal Report. Now, Maria Bartiromo.
Here's a look at what's making news as we head into a new week on Wall Street. In Washington, there is posturing, politics, and high-stakes poker, with America's economy at stake. President Obama's initial offer on the fiscal cliff was resoundingly rejected by Republicans. It included a $1.6 trillion tax increase. That's double what he campaigned on. It also includes $400 billion in entitlement cuts, and that would eliminate the need for congressional approval to raise the debt ceiling. After a slow start, the markets rebounded later on in the week, frequently following the latest hopes on a fiscal cliff agreement. America's economy, though, grew at a faster pace than initially expected in the third quarter of the year. The second reading of the gross domestic product showed growth at an annualized rate of 2.7%, spurred by stronger inventories and exports. The Securities and Exchange Commission is now looking for a new chairman. Mary Shapiro announcing this week she will step down in mid-December after nearly 4 years on the job. The Obama administration says it will announce a replacement in the near future. And if you're looking for a hot cup of coffee, Starbucks has a new way for you to spend a whole lot of money. It's introducing its most expensive blend, made from a rare Costa Rican variety called Geisha. It's $7 a cup, and so far it's available only in 48 stores. If you order one, drink it slowly. Enjoy every sip. Is the fiscal cliff a mountain or a molehill? Depends on who you ask. And my next guests have two very different opinions. Joining me right now are Sri-Kumar. He's Chief Global Strategist with TCW, and Jim Paulson, Chief Investment Strategist at Wells Capital Management. Sri, Jim, good to see you. Thanks very much for joining us. Maria. Great to see you. So, Sri, let me begin with you. Your thoughts on the fiscal cliff. You say even if Washington comes to a compromise, we're still going to see a drag on the economy and the markets. Why?
I think we are going up the fiscal mountain now, Maria. It doesn't have to be a fiscal canyon. You don't have to have a lack of agreement and falling off the cliff in order for you to have a negative impact on the economy. Even if you're coming down a fiscal slope with an increase in some of the tax rates, for instance, expiring the payroll tax cut to expire, alternative minimum taxes hit some people. High tax residents, New York, California, may find some of the deductibility of taxes is restricted. All of that is going to have a negative impact on consumption. And we have already seen the third quarter show that consumption increase was much slower than expected. And that's going to get accentuated as we go into the new year, which is why I think even if there is an agreement, the impact is going to be quite negative.
Jim, you disagree, right? You call this fiscal cliff a molehill. What do you mean?
Yeah. Well, I think it's sold as a cliff as though we're going to fall entirely off and have this massive fiscal tightening occur next year. I think what's much more likely, Maria, is just a relatively modest tax hike and a relatively modest spending cut, and most of the things is extended, and we live to fight for another day. Personally, I think we're going to have fiscal cliffs over and over again over the next several years. If you have a modest fiscal tightening next year, it's nothing new for the economy. We've had about 1% fiscal tightening every year of this recovery. The deficit has improved by about 3.5% in the first 3.5 years of the recovery. And so a little more modest fiscal tightening hasn't stopped the recovery and probably won't next year. I agree it's a negative, but you got to weigh that against the big drop in the unemployment rate, the revival in China, the 4-year high in confidence that we have now, the rising home prices and housing activity. A lot of other positives are going to help keep, I think, consumer and business and other things strong, even in the face of a little more modest tightening. Which
sectors, specific sectors, are at risk, even if there is an agreement? You say there are specific sectors at risk, even with an agreement.
I think the areas which are going to be at risk are going to be more the risk-on strategies, the aggressive strategies. For instance, technology could come under pressure. And some of the areas which have been hit more recently, such as high dividend stocks, dividend utilities, which have suffered, are likely to benefit because I don't think the taxes are going to increase that much on them after all. So you have some areas which are going to get affected. So I would say don't be aggressive. Don't look for economic growth to pick up. Be on the defensive side, and you'll be amply rewarded.
Which is why, Jim, people are sitting on their money right now. But you're saying that the Fed is still there. The Fed is in place. You've got the after effects of Superstorm Sandy, accommodative policy by the Fed, and you think that spurs growth in the U.S. But how strong will it really be?
Well, first thing, we've grown about 2.5% in the last 4 quarters, Maria, and I'm thinking we're going to go up to around 3% growth next year. And, I think, yes, there is some fiscal tightening, but that's nothing new, as I said. But look what we're getting. We're getting rapid money growth. We're getting record low mortgage rates. We're getting a drop in gasoline prices. We're getting a drop in the dollar. We're getting lower inflation, boosting real incomes. And it's working because we're getting more and more parts of the economy gearing. A year ago we had no bank lending. Now we have a full year of it. A year ago we had no housing activity. Now you see it. In addition to that, I think that next year's profile will be much more impacted by what happens in the emerging world if they pick up again than it will by what's going on in Washington.
I would differ significantly, Maria, in terms of where we are headed and the recommendation for investors. First, this is the slowest recovery that we have had with the sharpness of the recession that we had in 2008, 2009. Very different from what we had in the early 1980s. Second, Germany, including the rest of the European Union, seems to be going into a recession, and Germany entering it means 2013, first half is going to be very difficult. Chinese growth has already slowed significantly. I can't see where the US growth is going to come from. Our exports are going to suffer.
Jim, let me ask you this, because we're seeing a lot of activity at the end of the year as investors and companies try to beat those higher tax rates. For example, some companies issuing special dividends because they are assuming tax rates will go up next year, which they will. But you don't necessarily think this is good for investors, these special dividends that we're seeing.
Well, I'm okay with it, and if it's a dividend-paying company that normally pays dividend, like utility companies or high-yield staple stock or something, if they're going to pay a special ahead, because that's why shareholders buy their company. But I'm not okay with it in areas where I make an investment for companies for growth, and now they come up and pay me a special dividend this year. It makes me weary. If the best I can get from a growth company is they're going to use their cash flow to pay a dividend, I really question if they don't have any growth opportunities.
Real quick, both of you guys, Sri, what do you want to do with your money right now then in light of all of this?
I want to short the euro because I believe the dollar is going to be strong. Gold price will not go up. If you're looking for deflationary influences, gold price will go down. I would say fixed income with the 10-year treasury still in the 160 range, Maria. I look for it to go below 150, go there and take some profit from there. And all of those are going to be the places to be in rather than stay in cash.
Jim, what do you think? Sri is shorting the euro. What do you want to do in terms of allocating capital?
It couldn't be almost more different, Maria. We're finishing up the 4th year of positive returns in the stock market. I think that backdrop has constantly been the one that he's laid out every year. Too much risk, stay away, stay conservative, and yet the market's gone up every year. I think we're going to have the 5th year of double-digit returns in 2013, and that the fiscal cliff will come and go, and it's going to be driven more by revitalization of global growth and rising confidence. I would overweight emerging markets. I would overweight the manufacturing sector of industrials and materials, and also the financials in this country. I think it's a risk-on year, not a risk-off.
All right, we will leave it there. I guess, gentlemen, they say that's what makes a market, so we appreciate it. We'll be watching the developments in 2013. My thanks to Kamal, Sri-Kumar, and Jim Paulson. Up next on the Wall Street Journal Report, what the fiscal cliffhanger means for your wallet and your taxes. Timely advice for 2012. And later, the entrepreneur who went from living in his back of the car to running a major beauty company. Paul Mitchell Hair Care co-founder John Paul DiGiurio will join me. As we take a break, take a look at how the stock market ended the week. Back in a moment. Welcome back. If all the talk about the looming fiscal cliff has you wondering what it means to you, we've got some advice on how potential changes to tax policy could impact your wallet and your investments in lucky 2013. Donna Rosato is Money Magazine's senior writer. And Donna, it is good to have you back on the program.
Thanks, Maria. Great to be here.
Thank you so much for joining us. So how does the fiscal cliff impact our personal decisions about what investments we make, what to buy or sell before the new year?
Well, certainly there's a lot of worry about what it's going to mean for the individual person, individual investor. You need to think big term or long term. Your long-term investment strategy shouldn't be dictated by tax policy. There are definitely things you could do, but as Warren Buffett said in a recent editorial in the New York Times, he's never met a smart investor who has seen a good investment opportunity who said, I'm not sure I'm going to do it because I'm worried about what the taxes are going to be.
Right. So, but there are things that will happen over the near term that could impact.
There are definitely things you can do to put yourself in a better position. For example, I would recommend that people, if you are thinking about taking capital gains, if you have very appreciated investments, this is a good time to take a capital gains. Capital gains rate is much lower. I think you should max out your tax advantage vehicles. IRAs, 401ks, 529s, that's always a good thing to do. But if you do that now, you're going to shelter some more income. You're going to lower your income from whatever higher taxes would be. And I think a terrific thing to do now is to convert to a Roth. It has been a good strategy for people, but you're taxed on the conversion. That stopped a lot of people from doing it. If you do it now, though, the tax will be based on 2012's lower rates. But more importantly, the assets in your Roth, if you think tax rates are going to go up down the road, and I think most people do, you can withdraw them tax-free when you're retired.
All right. So what about the expiration of these Bush-era tax cuts on those who make more than $250,000 as far as a couple, or $200,000 as a single person? Any other taxes away from those capital gains that we should be concerned with?
Definitely. We've been talking a lot about investment, how it'll affect your investments, but it's going to affect people across the board. So you will see higher income tax rates, and that's going to have an impact on lower earning households a little bit less, about $400 a year they may pay more in taxes. A middle income family, it could be about $2,000 more a year. And if you're talking very high income people, even up to the 1%, you will see tens of thousands of dollars in higher tax rates. It's not just that, though. The expiration of the payroll tax holiday, that'll increase $10,000, and a lot of tax credits would disappear if nothing is done.
So you really want to have as much action that you can in 2012 while the rates are lower. Let me ask you about these tax credits that are also expiring, a number of tax credits expiring, some fairly commonly used, actually. Tell us about those and what you can expect.
That's right. You can really say, forget your taxes going up. There are a lot of credits and deductions that would go away, too. So, for example, the child tax credit, that's at $1,000 now, a $1,000 credit. That would be cut back to $500. The American Opportunity Tax Credit, which allows you to take a credit of up to $2,500 of college expenses, would disappear altogether. The things that Congress has put in place to reduce the marriage tax penalty, for example, would be gone. The AMT would be gone. So those are some things that would disappear that people may not be talking about as much right now.
Right. They're all talking about the mortgage deduction. They're talking about the charitable deduction. These are also on the table, possibly on the chopping block.
Those things are as well. And I think there's another thing that people haven't been thinking about so much too, but the estate tax. There will be a dramatic change in that. Right. Of course, that's been all over the board for a number of years. But what is on the table now, right now, estates up to $5 million are exempt from the tax, which is 35%. But that would drop to $1 million threshold. So, and then the tax rate would also go from 35% to 55%. So that's an area you want to think about, maybe gifting more, doing things to reduce your taxable, for your heirs, the taxable part of your estate.
Really interesting. Lots of things to do, actually, this year in particular. Donna, great to have you on the program.
Thanks, Maria.
And wonderful insights, as always. Donna Rosato. Up next on the Wall Street Journal Report, why the entrepreneur who went from homeless to having billions says he'd do it all again in today's economy.
We believe what we did would work, no matter how bad times were.